Hi, and welcome back to the Brilliant People podcast by executive search firm Assertitude. I'm your host, Linnea Jungnelius. Today, we're unpacking a masterclass in disciplined investing, how the best firms stay focused, move fast, and build leadership that wins. My guest is Brian Neider, managing partner at LeadEdge Capital, a $5 billion growth equity firm that's investing in software, internet, and tech-enabled companies. They've invested in companies like Toast, Spotify, ByteDance, and helping scale others like Asana, Alibaba, and Duo Security. Brian joined LeadEdge at the very beginning alongside co-founder and managing partner Mitchell Green and Nime Mehta. What started as a few people with a conviction about focus has grown into one of the most respected names in growth equity, known for its 700-strong LP network and its investing framework for exactly where to swing and when to pass on a deal. In this conversation, we'll also dig into how you scale a fund the right way, what's next in growth equity, and why the true moat in the business isn't code or capital, it's people. Okay, let's do it. Brian, welcome to the show.
Thanks for having me. Great to see you.
Brian, you've said great investing is about discipline, not prediction. What's your read on the current state of growth equity, and what's separating the firms that are winning from those that are drifting?
Yeah, I think that a lot of it is staying in your strike zone. And so you see a lot of firms that are more willing to deviate from what it is that they might have historically done. For us, we've been unbelievably militant around getting into those deals that we really feel like we understand the business, we understand the framework, we understand how to evaluate, and that's what's kept us successful and I think keeps a lot of firms successful. Stick to your knitting.
Stick to your knitting. Good advice. And you have stayed incredibly focused through every market cycle, worth mentioning. How are you thinking about today's environment, deal flows, valuations, LP expectations?
Sure. It's a very different market than anything that I've ever dealt with. So I started my career 20 years ago. I joined a firm called Bessemer Venture Partners, which was more on the venture capital side. And back then, all companies were on a hamster wheel. And what I mean by that is, as companies grew, they'd raise an appropriate amount of capital along the way. Company would be a software business that gets to $2 million of revenue. And they'd go out and they'd raise a $5 million capital round. And then they would get to $8 million in revenue off of that. And maybe they raised $10 or $12 million. And there were a constant flow of new opportunities at that company, and the venture capitalists were able to back them. I think what happened probably in 2020 or 2021 is that you had a lot of firms that wanted to write very large checks, and they'd turn around and say, gosh, this business got to $2 million of revenue. How wonderful. Here's $100 million. The companies didn't know what to do with the money. They became very unphysically fit. And the ramifications of what happened at that point in time actually ring true to today. And that's a very important aspect. So when you ask what's the state of the current market, the state of the current market is just different because whereas historically you'd have these companies that were consistently raising and they're raising in smaller bite sizes, today a lot of times the companies are not the ones that need the capital. The companies are fine. They're flush with cash. They raised a lot of money 5 years ago, 4 years ago. They're in perfectly good shape. And they've become much more physically fit over time. So they have a big balance sheet and they're trying to figure out their way. But a lot of times where the opportunities are to talk to the other shareholders. So it's not as simple as it used to be where it's, hey, look, company's willing to give you the data on the business, go raise their Series D. Today, it's a lot about cleanup. There's a big mess that was made. You've got a lot of investors that need to show their LPs exits. So instead of only looking at it through one myopic lens from a deal type perspective, you're looking at it not only from a primary perspective, but also through a secondary perspective.
I'm happy you brought up the 2020-2021 cycle because I think that's so important in terms of the shift from grow at all costs to profitable growth. And as you think about that, how has that changed how you underwrite growth and how you manage risk?
I think that it's all led by the public markets. So if you look in the public markets and you say, okay, look, let me bifurcate out or segment out all of the different companies, and you start looking at these businesses that have a poor rule of score. So there's this concept of adding the growth rate plus the profitability margin. If you add those two numbers, that gets you to your rule of score. And a lot of people will say, look, if you're a rule of 40 or better, that's a really solid company. It doesn't matter if you're 40% growth and 0% margin, or if you're 20% growth and 20% margin. It's just a solid business. You're on the right efficient frontier. And there's a lot of businesses back then that probably were growing 70%, but they might be losing 100% on the bottom line. And nobody seemed to care because the growth was all there. I think that today's market is just entirely flipped on its head. My feeling on the whole matter is we could never underwrite growth at all costs. It didn't necessarily make sense. You really had to understand the trade-offs, and it's a real capital allocation decision to say, okay, what is it that the company's actually spending money on? Is it efficient? What are the underlying principles around that? And if you could do that, then it makes for a reasonable investment. So for us, I think a lot of it is about understanding the unit economics of the business, underwriting it properly, and I would say for the most part, we were not really big fans of the growth at all costs, go-go times at all. So this market worked pretty well for us.
And how does that translate into North Stars in terms of the metrics you care about most and that matter inside of Lead Edge?
So the Lead Edge 8 is a framework that we've always used, which are the metrics that we really care about. This is more of a filtration mechanism than anything. We talk to about 9,000 companies every single year. So we have a really wide top of funnel. And we're having conversations with these businesses, and we need to find a way to whittle down the field, to figure out what is it that we're looking for, what is within our strike zone. And so there are about 8 metrics that we've defined that we really care about. And this set of metrics started really probably about 20 years ago when I was at Bessemer. We were calling too many companies. We had too much of a top of the funnel. And so the partners would say, gosh, can't we just cut this down a little bit? So the 8 metrics that we really care about, we care about size. So $10 million plus of revenue is something that we care about. We care about growth rate. A lot of investors make money through financial leverage or through buying things really cheaply. For us, we make money through growth. So we say, at a minimum, we'd like to see 25% growth at entry. Oftentimes, it's 50% plus or 100% in terms of growth rate. We care about margin structure. Gross margins are a really important indicator of the future flow-through and future profitability of a business. We care about the bottom line profitability. Is the company profitable or at least break even? And then there's a whole set of other metrics that we care about. We look for recurring revenue businesses, high retention rates. That's probably the most important metric out of any of them. If a customer is constantly walking away from the company, that's a problem. So one of our LPs always tells me, he says, when a customer buys your product the first time, they're buying your pitch. When they buy the product the second time, they're buying your product. And so that's very important. And then we care about the unit economics of the business, and we care about the customer diversification. We run every single company we speak to through that filter. And there's never been a company that's ever been brought to our pipeline meeting where those metrics are not tracked. That's what's important to us. And the reality of the situation is when you look at the go-go times, massive amounts of cash burns, the company's not profitable, terrible unit economics. Usually there's a lot of churn involved, and so you never quite get there.
Any investment firm, regardless of what your focus is, define your filters and apply them and follow them. Let's funnel that up to now what you report back to your LPs. I know you care a lot about DPI. Talk to me about that.
Look, the LPs at the end of the day, they're asking you, what is your strategy? And you have to define what that strategy is. Great. And then you have to succeed along that strategy. And LPs shouldn't be forgiving if you completely change your strategy, even if you're successful. And they shouldn't necessarily be forgiving if you do poorly. That's where it begins and ends. And so for us, generally the LPs are looking at 3 distinct metrics. They're looking at DPI, which stands for distributions relative to paid-in capital. So if an LP has paid in $1 million, how much have they already been distributed? That's realized, that's there, that's in their pocket, it's cash, right? The second metric that they look at is TVPI. What is the total value of the fund, total value of their holding relative to their paid-in capital? So if I put in $1 million and you're telling me that the fund is worth, that my stake in the fund is worth $3 million, that's great, awesome. If you're telling me that it's worth $1.1 million, that might be good if I just put in the money, might not be great if it's years later. And the last thing that they care about is the IRR. So what is their rate of return to them on a net basis after taking into account all the fees and all the carry and everything associated with it? Those are the metrics that they generally care about. In today's market, in particular, DPI becomes pretty important. The reason why DPI is pretty important is because a lot of the LPs are not so trusting of the marks, right? So what every firm does is it's an odd dynamic. The firm itself tells the investor, hey, by the way, here's what your stake is worth. And every single company is valued. A lot of LPs say, gosh, you told me that this thing was valued at a certain level, and then when you sold it, it was a lot less. This is a problem for me. So what they're really focused on today is, what is the DPI? How much has already been distributed to me? That's what I care about the most. And then let's go company by company of what's left to understand, are the marks kosher? Do they make sense? And it's really important for us, and I think we've done a very good job of getting the marks right and making them reasonable. And in general for us, we've always exited at a healthy amount above our marks, and that is a special thing, and it's going to keep people coming back to you because they're going to say you're constantly making a promise and meeting or exceeding expectations.
Really great points. And maybe we'd go into the secondaries part of the equation for that. How are you getting distributions back to your investors faster, and what are some of those ways?
There's a couple of different points that I would make as it relates to lead edge capital as to how we've been able to generate DPI. Of course, there's a method to the madness, right? And so I'd say that it hinges upon these two factors. One is we really try to define upfront what the different exit paths are. I think for a lot of venture capital funds, and we define ourselves as growth equity, but for a lot of venture capital funds, I think one of the problems is they have this ethos that says, just invest in great companies, the rest, it'll take care of itself. I don't necessarily subscribe to that theory. And the reason why I don't is that most companies don't end up being all that great. And so you end up having a lot of stuff that's in that fat middle part, the bell curve, where they're just okay. And when they're just okay, you got problems because nobody's knocking down your door to buy them, and it's pretty hard to try to sell them. And so part of what we believe is that you have to create some defensibility, and you have to understand the different exit pathways for a lot of our companies. So what are some of these exit pathways? In my estimation, there's probably 4 or 5 ways to exit a company. There's strategic M&A, right? Can a large public acquirer buy this business? There's private equity M&A. Can another private equity firm potentially buy this business in its entirety? Third way, there's secondary sales. Can I sell just my stake in this company? Do I have the right and the ability to just sell my stake to somebody else? Fourth way, IPO. Could we take this out and sell it to the public? And then the last way would be, do you have a redemption? What's in the terms? And then currently we're seeing a lot of secondaries in the form of continuation vehicles. So there's a couple of more esoteric ways to do it. But the reality of the situation is that most of the exits are going to come in those first 4 avenues. And I think where a lot of firms might get it wrong also is when they even try to evaluate this at the outset. They're so tethered to one exit path that it doesn't create the optionality or the incrementality that you need to actually facilitate those exits. So if you're investing in a very small market where there really aren't any strategic acquirers and it's never going to go public, and the only way you could get out is to sell to another private equity fund, it may be a great exit, but you're lowering your chances most likely. If you could define multiple exit pathways up front, I do believe that could be a very powerful thing. So that's the first aspect of it to me. The second aspect, which I think is really important and what's driven a lot of our returns and DPI, has to do with how we think about evaluating the opportunity to exit. So most firms have a wonderful investment committee. They sit, they deliberate about the investments. They talk about what's great and what the risks are and the drawbacks and the team and the market. Most people do get smart people in this industry. Great. So an investment committee is 100% present. What I don't think is as present is a disposition committee. And so the concept of a disposition committee is to say, what are our likely exit paths once we're already in something? Are there windows for exit? And can we evaluate it in a reasonable time period? And I think where a lot of firms stumble a little bit in terms of the DPI is they end up in a situation where they're great at figuring out to make the investment. But maybe there's a liquidity window that's open. Maybe somebody wants to buy stock in that company and it opens ever so briefly. And nobody's paying attention to it. Or they're not equipped to think about that exit. Or they're too busy. Or even worse yet, you have a dynamic where you might have a partner who's on the board of that company who's so obsessed with that business. And he or she says, gosh, I love going to those board meetings. I don't want to sell it, even if it's the right thing to do. So I often talk to firms and we'll be active. And if there's a liquidity window that opens, we're going to consider it. And that is an opportunity for us to re-underwrite the deal and say, okay, I'm going to make 3 times my money today. I think that in 3 years, I'll have 4 times my money. That's not where the end should be. The end state should be say, okay, actually, if I'm going to make 4 times my money in 3 years from now, that's a 1.33x on my 3x currently. Not a great IRR. I'll be compounding at 10% or 9% or something like that. That's not what we're paid to do. If there's a reasonable pathway for exit, let's evaluate that. And so I think at Lead Edge, one of the fastest ways for any of our team members to be shown the door would be to not surface or bring up an opportunity for an exit, because we always need to be considering it. We can't fall in love, and we always need to be disciplined in both our buying and our selling. I think that the combination of looking at the different avenues for exit plus the disposition committee mentality has served us very well.
Let's talk about another trend in the space, right? There's a lot of capital chasing the AI and the tech narrative. How are you filtering the real opportunity there away from a lot of noise in the space?
There's a lot of different dynamics at play in the AI world. I will start by saying, and I think this is really important that I say this at the beginning, AI will change the way everyone functions. It is unbelievable. When you think about a lot of these businesses in AI land, and we evaluate a lot of software businesses, you have to understand who they're selling to and what their business models are. And we need to understand what is their true stage that they're currently at. We have 700 individual LPs. They're all very unique. And I'll tell you a little story about them, and I'll tell you how that dovetails with the companies that we're looking at. So let's talk about our LPs first, right? We got a lot of LPs who serve on boards in corporate America, who are C-level executives in corporate America. And we ask them, we talk to them, what are you seeing in your companies? You're a Fortune 500 company, you're a huge tech buyer, you're on the board, or you're the CFO or the CTO or whatever. What do you see? And every single one of them says, I'm seeing AI. It's really important. I say, great, that's awesome. Tell me a little bit about the AI journey at XYZ company. And the company might be a tech company, it might be a company that makes consumer goods. The board has decided that AI is the most important thing in the world, and we're going to figure out how to use it now. And the CEO is saying, I totally agree with that. I'm delighted to find some budget to free up to go do a bunch of AI projects. And the CEO goes to their 10 direct reports and they say, hey, here's the story. The board's been asking about AI. I think AI could change the world. It's super important. Let's figure out some projects. And each of the 10 direct reports says, no problem. I'm so delighted. I got this budget. I get to do projects. It's awesome. That didn't exist a year ago. Didn't exist 6 months ago. Didn't exist yesterday. They're trying a bunch of different stuff. Each one of the 10, it doesn't always work out exactly like this, but each one of the 10 says, hey, CEO, I got great news for you. I tried out 10 projects. I tried 10 different tools. I got this one thing that will knock your socks off. 9 of them, not so great, but I got this one thing that'll knock your socks off. Let's discuss that. And then the CEO says, awesome. This is going to make us more productive. It's going to make our company better. We got to keep pushing on this. Great. Okay. All makes sense. AI is working. When that's reported back up to the board, the CEO is saying, this is great. Look, here's what happened. I had my 10 direct reports. They did 10 different projects. There's 100 projects going on. And out of those 100 projects, 10 of them were amazing. And 90 of them not so good. We don't need to worry about those. But 10 were amazing. So is AI helping the productivity? Absolutely. But through the lens of an AI investor, if you were to look at AI companies, what you'd see is like 90% of those companies provided a tool that may or may not be used after a year. And why is that? It's because the company that we're talking about is experimenting and they're figuring things out. And when there's an experimental market, that is a market that could look a lot more mature in many ways than other markets. So now we're seeing what's happening in corporate America. And now we're seeing what's happening in all these AI companies that we have the chance to invest in. They're growing like crazy. But the problem ends up being that when you actually evaluate them, they have oftentimes, not always, but oftentimes, a gross retention problem. And what that means is that the companies are not keeping their customers. And why are they not keeping their customers? Because everyone's running experiments. So it doesn't mean the companies are bad. It doesn't mean that the companies won't be successful. What it does mean, however, is that there's a wide distribution of outcomes. And you're going to have a lot of companies that today might be 50, 70, $100 million revenue companies and growing fast, that a couple of years from now, they just flame out and the economics don't work. And so the visual that I like to use and what I like to describe to people is I say, look, picture you've got a bucket of water And that bucket of water represents a company. And that bucket is filled to the brim with the water. And picture that there's a little pinhole in the side of the bucket. And the water's dribbling out. And at the beginning of the year, the pinhole gets placed there and the water's dribbling out. And you just you got a hose and you sprinkle a little bit of water on top of that bucket. The water overflows. All good. There's retention there. The bucket's retaining most of the water. Now picture you've got a bucket, and the bucket has 3 gigantic holes in the side. It's still filled, but there's 3 gigantic holes. The water's rushing out as fast as you can imagine. However, there's a gigantic hose on top of that bucket that's spraying as much water as you could possibly imagine into that bucket. That's what's happening in AI world today. And so the real question is going to be, which companies have buckets where the holes start closing up? And we need to pay attention to that.
Let's talk about that and in the lens of going back to where it all started. And you guys launched Lead Edge, small fund, you didn't have a playbook yet, no brand, and pretty tough to do. Back then, what were you trying to build that didn't exist yet, and what did those early years look like?
20 years ago, I was hired at Bessemer to do a job which was cold calling. And I didn't know exactly what I was getting into. They hired me and they said, look, we've always done our deals the same way. We have relationships and inbounds, but we want to go outbound because we think that there's real opportunity to find interesting businesses that we wouldn't otherwise find ourselves. About a month after I started, they said to me, look, there's going to be this other person that we're going to hire to do this job. He's going to share an office with you. You should meet him. I said, okay, great. Mitchell's now my partner at Lead Edge. We've been together for 20 years. One of the things that we realized was a lot of times the best companies, it would take a long time to get through. And when you found the most interesting companies, you'd have 10 minutes on the phone with that person, and you'd have to really sell them as to why you are more than just capital. And one of the things that we did that I think was pretty smart was we'd ask questions about what they were doing uniquely well and what they were doing poorly or where they were lacking. That gives you a lot of insight to try to continue a conversation. Because if somebody says to you, my software company is doing great, we're growing by 70% a year, we're profitable. We really learned early on that if you figure out how to help people and you figure out where people are strong and where people are weak, that's an inroads to have a conversation, which leads to an inroads about how you could help further, which leads to an inroads about a possible investment. So when Lead Edge was started, and my partner Mitchell started the firm a number of years ago, and I joined shortly thereafter, a lot of his vision was, let's have a unique limited partner base. So most funds would have limited partners that are like endowments and foundations and pensions. And Mitchell said, let's flip that on its head. And the concept would be, let's raise capital from a group of individuals who could be strategically helpful to our firm throughout the deal process. And if we could do that, then we have something to offer up to all of these companies. And it's not just serendipity that you're connecting two groups. It's actually like more systematic. So we started out, and our first fund was a $52 million fund in 2011. It had 100 limited partners. Every single one of them was an individual. Most of them were executives and entrepreneurs themselves. A lot of them actually were people that Mitchell had cold called when we were at Bessemer together. So when we talk about the beginnings, a lot of it was, how do we create a value-added approach where we could, in turn, help companies have a better process, make better decisions?
Pick up the phone, people.
Absolutely.
Yeah. I mean, there may be nothing that can be as powerful as even one introduction can change trajectories and open up these avenues that you don't think about. And
Sure.
so the way that you've truly integrated it, because I think a lot of firms will boast, look like, we will introduce you, we've got a network, we'll lean on our LPs, but this ability to systematize it and just the pure scale of what you've built, I think is really impressive and distinctive. Let's think about other pieces of the platform, because you took it from a startup to a $5 billion platform today. Were there other choices or principles that underpinned the Lead Edge?
I would say that there was a lot of it was around hustle. You had to get out, you had to show up. None of us were afraid to, because we had so much of a cold calling background, and my partner Nime did as well at another firm. We were never afraid to show up. And so getting on a plane, having an awkward meeting, it was never something we were afraid of. And I think in the early years that really helped us out because nobody knew who we were and we had to create a brand that worked well, paid dividends. I think we had a lot of flexibility also in terms of the types of deals that we did. So we were militant and rigid about the types of companies that we invest in and figuring out what our framework was and those 8 criteria. Where we were flexible was the deal type, and we would be willing to participate in majority deals or minority deals. And so as long as you know exactly the type of company that you're investing in, and you're militant about knowing the metrics and where you fit into the world, then it's a matter of being flexible in terms of deal type, because you could find a company that meets all of your criteria, that's priced reasonably, that you feel very strong conviction about. But if you're only a Series C investor and that's all that you do, and the company's looking for a buyout, you got an issue. But if you could have the flexibility and the dexterity to be able to evaluate those types of deals, I think it leaves you in a better place.
How about when you reflect back on the evolution and the journey of the fund? What was the hardest muscle to build, and also keeping the DNA that made you successful in the first place? And I think about that in terms of advice maybe for people who are looking to start a fund and scale up like you guys have.
When I joined, there were 3 of us looking for deals. We had 1 analyst that was cold calling, and we had our CFO and a couple people to do our operations to make sure that everything ran smoothly. When you're doing that, everybody does everything. It is all hands on deck. I was the one early on that would create the questions for our reviews program and would create the matrix of who reviews who, and would be the one that people yelled at if they came to the firm and it was their first day and they'd say, "Where's my laptop?" "I don't know, I forgot to order it." It's like a bunch of chickens running around with their heads cut off. And that was fun. I really enjoyed it. And I think that for some people, that's the best time within an organization, because you're very optimistic. You don't know what the future is going to hold. You're all rowing in a direction to try to build something, and everybody knows everything that's going on because you have to. And as we've scaled the organization, I think that one of the hardest parts is really being able to communicate and make sure that everybody understands what the message is, what the mission is, and really being in a position where people understand that over time, you actually have to do less, not more. And what I mean by that is you need to specialize. So at one time, I was leading investment deals, and I was our chief compliance officer, and I was leading our HR stuff. And over time, we split that all up. And I'm happy to jump in and help with any of that stuff now. But we need people focused on it, because each one of those different lanes, each one of those different areas becomes very much a full-time job. And that's hard. And it's a tough pill for many people to swallow within an organization who have been here for a long time, because they like knowing everything. They like being involved in everything. It doesn't always work that way. And then we're going to hire somebody who's doing what you used to do over here. You might have been strong at it, but that person is now responsible for it. You got to take your hand off the wheel, because this thing, number one, is getting really big, and you're going to end up being mediocre in 2 things rather than great in 1, and then finding somebody else great in the other. And it's a hard thing as you scale to communicate that, but it's been good. As far as the DNA, we have to keep that hustle and creativity. We do. And that's hard to do. We have this thing that we do every couple of weeks where one of our HR people came up with this idea. I thought it was great. I said, what about just doing like war stories? Where every couple of weeks, you just talk about a deal. So we'll have a partner come in, and it's not only the good deals. In fact, the good deals are like easy to talk about. Everybody knows those stories. Like when someone, like one of my partners would get on a podcast, they talk about the good deals. Who's going to talk about the bad deals?
I'm happy to get into it.
Yeah, that's
I'm
right.
just kidding.
I'm happy to talk about it if you want. But the reality of the situation is, if you can discuss that as a team, and you talk about the lessons learned, and you do that postmortem, all of a sudden you got kids that are 23, 24 years old, and their faces light up, and you see who's excited by that, and you see who's there for the right reasons. And that's been a really good thing. And what I get the most excited about is when I have young folks, team members that are in their 20s, 30s, and they're coming and they're saying, "This looks like that deal was done when you were in high school." God, are you serious? And like, this was the dynamic, this was the dynamic. I'm like, how do you know that? Like, I read the memo, you gave a talk on that last year. Let's talk about the lessons learned and the threads and where we should push on this one and what questions we should ask. That's a very powerful thing. And that's how you keep that hustle and that culture. culture.
All right, back to the history of Lead Edge. Look, you've touched on the LP network. The key part I want to dive into a little further is how you activate that network. Because again, how do you use them to drive impact and still keep this high signal, right? You can't ping them every day, but you still want to keep quite a trusted personal connection. So what does that look like in practice?
Let me take you through how the LPs help with the deal continuum, but I'll take one step back first is to talk about what we normally see with these LPs. We're introduced to really interesting people all the time because we have a big network now, and many of these folks have friends, and they introduce them to their friends. And oftentimes you see the same patterns emerge. It's not identical, but everything rhymes. And usually when I meet with a prospect LP, they'll be somewhere plus or minus 8-9 years from retirement. They've had a long career. They're seeing themselves retire at some point in the future. They just retired and they're keeping their networks fresh. And I always talk to them and I'll say, tell me a little bit about why you're even interested in talking to me. What are you investing in these days? And your knee-jerk reaction is, okay, this person was the president of a Fortune 500 company. They must be a genius investor. They're geniuses insofar as that they're just intellectually smart. But they don't necessarily have reps on investing. They haven't talked to thousands of companies. And so oftentimes what you hear is, oh, I was the president of a company that was a manufacturing business that did consumer products. You say, okay, that's great. So tell me a little bit about what you're invested in now. You retired a year ago. I said, my brother-in-law's friend has a biotech startup. He said, oh, geez. Okay, tell me about that. Oh, it's been interesting. I invested about 3 years ago. I thought it was going to be amazing. They were getting through, I don't know, clinical trials of some sort. You say, hold on, I'm going to stop you there. Do you know anything about this industry? No, I don't know anything. Do you have interest in it? They wanted mentorship. Okay. Did you look at a lot of other deals? Nah, my brother-in-law got me involved in it, and then my son's friend had another thing. And before you know it, I had 5 different deals, and oh man, it's taking up a lot of my time. That's what we're dealing with. It doesn't mean that they're not smart. They're oftentimes geniuses. It's just that they don't have the reps. And so what we say to them is, look, how about this? Why don't I define for you what it is that we invest in? I'll talk to you about the tech ecosystem and software and internet type companies, and then I'm going to define for you the metrics that we look for. And they say, gosh, those metrics sound great. I would want a company that's 20 million of revenue growing 70% a year. I'd love to be invested in a company like that. I said, okay, great. And they said, why don't I see any of them? We have 18 people that are cold calling, picking those companies off before they get to you. And you are just waiting for what comes across your desk. So that's why you don't see them. So here's my pitch to you. I'd like for you to come forward and become an LP of ours. And I'd like you to engage with us. And we're not going to be annoying. We're not going to bother you every single day. But a couple times a year, I'm going to have a rifle shot ask of you. And I'm going to say, hey, I think you could help with X or Y. Are you willing to do that? And they say, sounds like a pretty darn good idea. And that's what gets people engaged. Now, once they're engaged, because that's a very common thread, a common story that we hear, once they are engaged, they help throughout the life cycle. So let me give you a couple of examples. When we're sourcing, we might be calling a company 20 times. They never get back to us. We're hitting a brick wall. Our job in sourcing is to make sure that we break through that brick wall. We don't just hit it. And so one of our analysts will come to our hard to crack meeting and say, look, I've tried calling this company 20 times, can't get through. They're based out in Detroit. Okay, great. We go out to our LP base that's in Detroit, and we write out a note and we say, we're really interested in company XYZ. Here's the reasons why. Does anybody know this company? And inevitably what happens is that one of our Detroit LPs, who's super successful and very well connected, says, I could get to that company. That person is in my YPO forum, or that person knows one of my friends, or I've heard about that one.
It's my neighbor. Yeah.
It's my neighbor, whatever it is. Yeah. It works. So that's on the sourcing side. On the diligence side, the LPs help us a lot because we're investing in software companies, and oftentimes those software companies serve a particular vertical. So wouldn't it be great if we're investing in the automotive software category and we have people who run car dealerships or people who work at the big automotive manufacturers? They could give us some guidance on that company. That's a very powerful thing. And then once we're invested into a deal, the LPs help in a multitude of ways. It could be for recruiting. It could be certain types of particular tactical or strategic advisory. It could be customer introductions or partnership introductions. And as with most things in life, it's all about communication. And what we communicate to them up front is, if you're going to invest with us, we're going to expect you to help. It'll create a better ecosystem for us. It'll improve your experience with us, and we'll all win together. And that's what we try to do.
And I know you have a person dedicated to coordinating a little bit the lay of the land.
We do. It's more than one. Yeah, we have a lot of LPs, and it's very important to understand what their backgrounds are, where their expertise lies, and then also where they want to help. Some people, they invest with us and they say, I have a lot of guidance to give if you're moving a company into a new location or if you're going IPO. I've done all that stuff. I'd love to talk to CEOs about that. I don't really want to make a lot of customer contacts for you. I don't want to put myself out there if that's all right. So, okay, no problem. And other people are like, I'll open up my Rolodex to anyone you want. If you say it's a good company, I'm happy to do it.
Yeah.
And that's good too. And once you understand where people are coming from and where their expertise lies and what they want to help with, then you build out a matrix and you could really understand how you could leverage them to the best of your abilities.
Talk to me a little bit more about this strike zone now. So you talked about the 8 criteria that you look for, but talk a little bit more to me about like how has it changed over time, and is there anything else that you would highlight about the framework and how it gets applied?
It hasn't changed much over time, actually. We've added a couple of metrics. It really has not changed much. And I'll tell you what has changed, which is when we were smaller, we were still looking at the same companies through the same lens, through the same framework. That's been remarkably consistent. However, we would be begging to get into these deals. So it was, there's a company we found, we really liked it. They'd say, look, guys, we're raising like $150 million primary, secondary round. Your fund is $52 million. You write $4 million checks. I'm sorry, why are we even talking to you? Oh, we're going to make introductions, this, that, whatever. Fine. And we'd get in and we'd wedge our way into these deals and we'd write a $4 million, $5 million check out of a $150 million deal. If you fast forward to today, we'll do that deal ourselves. And so in some ways it's harder because there's competition there. In some ways it's easier because we actually have a brand name that people could recognize and referenceability and CEOs that say great things about us. And that works to our advantage. In general, I'd say I'm optimistic about the future because our flywheel is spinning.
And what about post-acquisition? Talk to me a little now about your value creation team, your capabilities, and where you lean in to drive impact.
As it relates to our limited partners, they're a big value creation driver for us. So I talked a little bit earlier about they help with recruiting, they help with specific advisory, they might help with customer introductions. That's a specific set of things that they do. But one of the things that we realized was that we'd see a lot of commonalities amongst our companies, and they'd oftentimes be asking for help on similar things. And sometimes it was pretty deep in the weeds. And so we created 3 kind of lanes for that. And the questions came in go-to-market, so sales and marketing. And it would oftentimes be, hey, look, we're creating our sales compensation plan. It's not immediately evident what we should do. How do we analyze the data? How do we think through what it should look like? How should we build this out? And we hired a couple of people that lead that effort for us. And what they do is they work very much directly with the portfolio companies to help them in that regard. The second lane that we saw a lot of activity or a lot of questions in was around HR. So how do I run the best reviews process? I've got to recruit a bunch of people. What's the best practice in terms of interview guidelines and case studies and who's going to do it and how do we schedule this all? Okay. So we created an HR practice, and we have a couple of people in that practice, and they primarily work with our portfolio companies to deliver on that. Third area, and it's the most recent one, is around AI. So every company is asking us, like, okay, AI is important. We recognize it. What are the different things that we should be thinking about? Do you have any ideas for us? We have some ideas, but what would be great is if we have a couple of people in our firm who are solely responsible for it, who have taken demos, who have used a multitude of AI tools. And then they could go to the company and say, hey, look, let's map out your organization and let's figure out a couple of ways that we think AI would most likely be helpful to you. And here's the different selection of tools, and I've got the right rep to talk to at every single one of these companies, and here's what the tools do, and here's my opinion on the drawbacks, and here's my opinion on the strengths of this company. And that short circuits a lot of research for our portfolio companies, and they're very appreciative of it. So You could build that out further, and you could say, look, we need people who are experts in engineering, and we need people who are experts in international expansion or whatever it might be. And yes, we could do that. But for a firm our size and where we sit, we think that most of the bang for the buck is in those three lanes.
You've touched on a number of great resources, capabilities across the board here. If you were talking to maybe a CEO that you're discussing doing a potential deal with in the market, or even like the portfolio company CEOs you have now, what advice would you give to them about how to effectively or better leverage these capabilities and resources that you have?
A lot of it starts at the board meetings, and we explain to them, here's what the LP network can do for you, and here's how they might be able to help. And then here's how our full-time value creation team might be able to help. And we'll walk through those different lanes. It probably starts even more before the board meetings. It's like during the investment phase, when you're thinking through what are the possibilities for this company, a lot of discussion about how we might effectuate improvement or change. And we need companies that are bought into that and want that type of assistance. Communication is the key on all of it. Here's the different things that we think are the most important. Here's where we could provide you some assistance. And then along the way, offering it as issues come up. And having that in-house team is quite a valuable thing for us, and it's quite valuable for the companies in which we invest.
You've seen and worked with thousands of portfolio company leadership teams and talked to them over the years. As you think about the best performing companies, what do they have in common in terms of leadership, execution, culture?
I think that in general, they have a sense of urgency. They have a pretty clear vision generally of what they want, but they're not afraid to adapt. But at the end of the day, they work with a sense of urgency. They act decisively, they make moves, they take action, and then when it works or doesn't work, they act decisively again, and they take moves, and they take action.
A lot of it you talked about comes back to people. Is there anything else you would call out in terms of either board design or the CEOs that you've seen who are truly exceptional in your portfolio in terms of what stands out about them?
Oftentimes what we see is something that skews too far one way or the other. And what do I mean by that? Let's say that we're looking at a software company, and that software company sells software into the healthcare space. If the entire board is dominated by healthcare executives, you've probably got an issue. And the reason why you have an issue is this is a software company. A lot of the discipline around that company is understanding what the right metrics for success are for a software company. It's understanding product design strategies for a software company. The domain expertise is quite important, but if it completely overwhelms all of the know-how around the functional areas of the business itself, you're going to end up with problems. The reason why you're going to end up with problems is all of these folks are going to have such strong opinions on the ways in which you need to go, but they don't necessarily have an idea of how to potentially effectuate it. On the other side of the equation, you could have a situation where you just have really smart people. They don't have any know-how in terms of that industry. Oftentimes we'll see for startups, they'll get boards that are like a bunch of really illustrious business people, but they don't necessarily have anything to do with that industry, and they don't necessarily have any know-how in that particular business segment. They're not software people. That's a recipe for disaster. So to me, it's having the right mix between industry expertise and the functional expertise of that business. So if you have a healthcare software business, it might be having people who are experts in and around the healthcare field who could help you navigate and speak as a voice of a customer, and then people who might be software experts, and then people who might be go-to-market experts, and you bring those together and you can really create quite a special organization and create the right guidance and attitude for the business.
What else have you learned about building really incredible teams, especially executive teams and CEO hiring, to create those special environments that then make companies thrive and obviously ultimately get your return on investment?
I think a lot of it starts with the right sort of interviewing process, which oftentimes recruiting is like an entirely separate thing. And people show up to the company and there's not necessarily buy-in across the board, and that makes it difficult. If you have the right process around the hiring process and you have the different people that are interviewing ask different questions to get different perspective on the candidate, and then you have a well-designed case study that will be indicative of what that person might need to do, it can create a lot of buy-in within the organization, and that can ultimately allow somebody to hit the ground running and to be that missing puzzle piece. So I think a lot of building a great team starts from the top, which is, let's start with the right recruiting process, get the right people in the seats. It's not that you're going to get it right every time. You're not. But incrementally, if you're better at that, and incrementally, if you have more successful hires, you're incrementally going to become more of a successful company.
You've spent a really long time now helping both great companies and great leaders grow.
Sure.
And as you think about the next decade, what are you most excited about as it relates to the industry, to Lead Edge, or even for yourself?
In terms of our firm, what I'm excited about is we've not only built a set of funds, but we've built a company. And I'm really excited about a lot of the people that work at our organization. I'm 44 now, and when I joined, I was 30 or 31, and I didn't know what it was going to hold. I didn't know what was going to happen. And we put one foot in front of the other, 6-month increments, and strung it together, made a series of good decisions, and it worked. But one of the things I'm super excited about at our firm is that there's a lot of people who have been with us for a while, and some that have joined more recently, and I think that they're really special. And being able to give them the latitude and the freedom to execute and to come into their own. As far as what I'm excited about in the investing ecosystem, it's a hard question to answer. I wouldn't necessarily point to a particular sector. What I would say is markets can create odd dynamics, and there can be dislocations, and weird things happen. And I get excited by that because as things ebb and flow, you have to figure out where the opportunity is for you.
And what about on the personal side? Is there any particular lesson that took you the longest to learn as an investor or as a leader inside of Lead Edge?
It goes back to probably something I said before, which is communication. And it's just setting objectives and being able to clearly communicate with people. That builds trust. It allows you to set expectations. And if you do a good job communicating with people so that they understand where your head is at and what you're thinking, and it doesn't feel like it's a personal assault or an attack, but actually more of a discussion with the best of intentions always. I think that's one of the most important things, is being able to communicate well. Because if you can't, it gets very frustrating.
Yeah, exactly. You always have to stay focused on where are we trying to get to? And like
100%.
together, what's the goal? And like what productively is the exchange that's going to get us there?
Sometimes the answer is, I'm not sure at this very moment.
Yeah.
And that's okay. But by saying that, you're now communicating the circumstances and what's in your brain, as opposed to like running around like a madman.
Yeah.
And I think that level-headedness and being able to communicate and articulate a vision and articulate where we're trying to go, people rally around that.
Any non-negotiables or routines in your life that help you to show up as your best self at work every day?
I'm a pretty traditional person. I met my wife when I was 17 years old. I had kids when I was relatively young. I'd say that we live a pretty traditional life, and I like to be able to be with them. You got your friends, you got your family, you've got your work, and I feel like I've spent the last 13, 14 years work and family and trying to build that and being as successful as I can in both. So habitually, I would just say I just spend all of my time in one of those two places, and if I do that, I feel like that'll bring me happiness and joy, and good things will come out of it.
You mentioned giving up a lot of your life, right, to build this thing at Lead Edge.
Sure.
And that's a lot of sacrifice. Do you have thoughts on how you balance this really high level of performance and achievement while staying grounded in family and the things that you enjoy outside of work?
I'll have LPs that'll meet me from time to time, and they'll say, you're the exact same person that I met 13 years ago. Nothing's changed about you. And when they say that, it makes me very happy. And so I think a lot of it is just staying humble. We've been successful, but I made a lot of mistakes. And I go home and my kids are yelling at me about whatever it might be. And my wife is yelling at me to take out the trash and to clean up the kitchen and to help with this or that. But our household is a normal household. And I think that it's very easy to get excited by the trappings of some of the things that life can offer you as you build a company and achieve certain financial success. it's like the exact same thing as it always was. And as long as you don't have people doing everything for you, I still fold the laundry when it comes out of the dryer. Like that.
I have a load waiting for me.
That will keep you normal.
Yeah.
But for me, it works very well to do all of the things that I always did. I'm still friends with the same people I was in high school. It's just, you got to keep it the same and just realize that part of it is I've gotten lucky. Part of it is that I've worked hard. Part of it is that I might have some competency, but just keeping it normal.
Yeah. I want to talk a little bit about what you're reading, what you're watching, what you're listening to that's shaping how you think right now.
I pretty much only watch sports. I'm a huge sports fan, so now it's football season, so I'll watch a lot of football, and I really enjoy watching golf, and I watch a lot of basketball when it's in season. I do, because I live in New Jersey and I come into New York City every day, I have time to listen to podcasts, so I do listen to a lot of the investing podcasts. I think that they're amazing. But my favorite podcast is probably How I Built This. Guy Raz does this podcast around just entrepreneurs and what their visions were and how they built it. And I always find it to be fascinating. People start with these ideas and then they're able to build them up. And I really like hearing about the evolution of businesses, and I enjoy that.
Our tagline as a firm is brilliant people at work. So I have to ask about any brilliant leaders that you're watching closely right now.
I would say that some of the most brilliant leaders are the people that work in my firm, and I get a front row seat every day to work with Mitchell and Nime and many of the others. I'm always impressed with the way in which they're able to handle themselves, and I learn so much through being with people that are better than me, where I could level up my game. I'm always paying attention to them. They're amazing.
All right, so you've made it to the end. We like to do a quick lightning round before we wrap up, just quick instinctive answers. So the first one is purposes.
Purpose is being needed.
Leadership is.
Leadership is being able to guide even in the face of adversity.
Success is.
Success is delivering on expectations.
Brilliant leaders are 3 adjectives.
Brilliant leaders are fair, decisive, and work with a sense of urgency.
Brilliant investors are.
Brilliant investors are consistent, thoughtful, and truth-seeking.
I perform at my best when.
I perform at my best when I'm doing something that I enjoy.
Brian, this conversation was such a good reminder of what it means to be focused, work really hard, but also have some fun along the way. So thank you so much for joining today. Thank you to Brian Neider for joining us today on the Brilliant People podcast. I'm Linnea Jungnelius. If this episode sparked an idea for you, please subscribe or rate the show, or share it maybe with someone who would like these kinds of conversations. It helps us to bring even more brilliant guests like Brian to the show. And follow Assertitude on LinkedIn for how to lead and perform at your best. Until next time, stay brilliant at work and know your strike zone.